The inflation numbers seem to be cooling. The economy seems to be cooling. But what does it mean for your money? Stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels. And today, we are talking about the most recent economic news. Finally, there's hints that the Fed is getting inflation under control. Why? Because the economy is slowing. In fact, the latest GDP report showed an annualized rate preliminarily of slightly over 1% per year. So today, we're going to explore what that means for your income, what pieces of news you should react upon with your portfolio, and which pieces of news that you shouldn't. So, Sarah, we got a pretty big show here planned today.
Absolutely, Dave. And of course, I love spending time here with you on the show and with all of our listeners, of course, because when we talk about these economy shows, we do these market update shows and we talk about what's going on. It's always interesting to see the difference between what the reports say, what all these bureaucracies say the numbers are, and how the media reacts to it and how they want to promote it or kind of shape the narrative in a certain way.
We know it's funny, the media blows things out of proportion. Yeah. And of course, we got to be careful because we're the media, right?
Well,
in some ways.
We're more of an educational program,
that's right? We're the honest media. Yeah. That's right. And, you know, it's interesting what happened because the 10-year government bond, the interest rate on it, climbed up over 4.6% in May. And then when this news came out at the end of May, it dropped down to about 4.5% just within a matter of 2 days. Yeah. And then beginning of June, actually dropped down under 4.4%. And that's important because, you know, when interest rates go up, the value of all financial assets tends to come down. Interest rates go down, the value of all financial assets tends to go up. So what's happening now is that, you know, everyone's speculating on when the Fed's going to start lowering interest rates.
Yep.
And now with this last report, the economists who were saying they're probably not going to lower interest rates till December are now saying they're likely to lower interest rates maybe even in September. So again, one report doesn't make a year, but it was interesting how we had kind of a change of course.
Yep. Well, we had the Fed holding steady for quite a while and not wanting to really lower them anymore. And you made the analogy with the sailboat analogy, which is that sometimes the Federal Reserve, the moves that they do, it's too late essentially, or they do something too drastic for what they need to do. By the time we see it, we see the consequences of it. It's almost too late. We're playing a game of catch up.
And I give them a lot of credit for being patient this time around. Because historically, you know, we've never had a soft landing. Historically, the Fed has always caused a recession trying to fix inflation, right? But they've learned they're being more self-disciplined because last summer, the inflation rate was starting to trend downward and the GDP was starting to trend downward, which those two kind of go hand in hand, right? If the economy is growing slower, then hopefully they'll help with inflation. People aren't spending as much money.
Not as high, exactly.
But in the last quarter of the year, everything got ramped up again. In terms of GDP, inflation stayed ramped up the first quarter of this year. So finally now for the first time, we're starting to see some numbers cooling. So hopefully having a steady hand at the Fed has helped and, you know, fingers crossed can orchestrate a safe landing for the first time.
Yep. Well, our first Ask Dave question for this show has to do with a common fallacy, something that a lot of people think out there. And this comes from Jeff, Tennessee. He says, if the economy is slowing down, then why is the stock market at a record high?
All right, Jeff, great question. And the answer is because the stock market is forward-looking. And the stock, you know, as much as 9 months, maybe as much as 18 months in some cases. And when the stock market's forward-looking, it's reacting on two things. It's reacting on earnings, and do we think that the market's going to continue to be able to increase earnings, that most companies are going to be able to increase earnings. And so for this last earnings season, if you will, for the last quarter has been pretty favorable. Consumer sentiment seems to be strong, so everyone's hoping that corporate earnings can continue to grow. So that's the first thing. The second thing, Jeff, as I said, when interest rates go up, the value of all financial assets comes down. When interest rates go down, the value of all financial assets actually, they go up. So in this case, a lot of the market is forward-looking to say, okay, when are interest rates going to start to trend downward? Because that's good for the market. And frankly, that's part of what we've seen with the market hitting record highs, right? I mean, we stumbled off record highs last year, came down. Beginning of this year, we struggled a bit, and then all of a sudden it started to take off. So that is it. But I'm afraid that when interest rates actually start to drop, we might see a rotation in the market. We might very well see that all of a sudden those high-flying growth stocks, tech stocks, start to cool down a bit, and people are going to be looking to get income, in which case maybe the dividend stocks will start to take off. So we'll have to see. But Jeff, great question, and that's the reason why sometimes one piece of news doesn't go hand in hand with the other.
Yep. Jeff, thank you so much for sending in your Ask Dave email. And if any of our listeners have a question, maybe something you've seen out in the news or something that you'd like some answers on, all you have to do is email us at askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about everything going on in the economy, what's going on in the markets, and really ultimately how it doesn't really affect your retirement depending on how you're invested. So Dave, we talked a little bit about how inflation seems to be cooling so far based off the recent reports. Do you think the Fed is going to be lowering interest rates sooner than later? Do you think that would be accurate? Like some of those other people are saying?
I've been in the camp of later. There was at one point where they thought they'd lower interest rates, a half dozen times this year, and I never thought that was going to happen. Yeah. Because they're worried about inflation. So I thought maybe toward the end of the year, and I'm still in that camp. But we'll see if we get a couple more increasingly cooling off reports, if you will, with inflation, or you get a negative or a GDP that starts coming down. We start seeing right around mid-August is when we're going to start seeing preliminary reports for the GDP for second quarter. Yeah. And if we see that coming down, then that probably means that the Fed might lower in September. But I'm at this point with all the summer travel and the money spent, I'm holding out for the end of the year. I think we're going to see a little bounce back in those economic numbers. So
if that's the case, if it's going to be to the end of the year, what should our listeners do now maybe to take advantage of this still low rate environment?
Well, the reality is that, you shouldn't make a change in your portfolio unless something is materially changed in your life or with your goals. Any adjustment from stocks to bonds or from one sector to another should be minor. And for most do-it-yourself investors, they shouldn't be doing that at all. Now, professionals might do it, but professionals are going to be doing it to a small degree. Again, not making wholesale moves. You're not going to be selling stocks because you think the stocks are at a peak and buying bonds because you think interest rates are high. That's not what's going to happen. Or at least that's not what should happen, because if you do that, most of the time you're going to underperform. It's like you're on the highway and there's a car that's zigzagging, passes you out, and you get to the toll booth, and guess where they are? They're right behind you. And that's what happens a lot of times when you switch too many lanes in the investment market.
Yeah, it's funny how that works, right? I think there was a study one time where they timed it out, or maybe it was Mythbusters, I can't remember. They did something, and I think it ended up being like a 10, 12-second difference, and the person doing the weaving in and out and driving recklessly versus the person following the rules of the road.
And which one are you with that fancy sports car you roll around in there? Is that I think you have to be the weaving in and out person.
Oh, no, definitely not, Dave. I drive very safely, especially down in South Florida, where we have the highest car insurance rates out of anywhere in the entire United States of America. So
just so you know, the lovely Sarah Samuels rolls around South Florida in a Nissan 370Z. So
it's a lot of fun. It's a fun car.
I don't know. I have a tough time believing that. But
I can't drive too fast. That's the most important thing.
The bottom line is, yes, you really should in most cases, stay the course. And right now, nothing has changed materially in the news that would justify a change, a major change in allocation. But coming up, we will talk about the situations where you might want to execute a change in your allocation versus those situations in which you want to stay the course. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and on today's show, we're talking about the recent reports looking at the economy, including some signs that inflation might be cooling down. And Dave, just a few minutes ago, you answered a question from one of our Ask Dave listeners who was wondering why the stock market is at a record high if the economy is slowing. And you said that if interest rates drop, typically, and if growth stocks top out, then dividend payers might end up moving into income.
Sure. I think, let me elaborate on that. I think that makes sense. The first thing that I want everybody to know is that the reason the stock market's up now is heavily because of the tech stocks, specifically seven, the Magnificent Seven, right? So you have 500 stocks in the S&P 500 index, but with the Magnificent Seven, they're bigger companies. So they have a bigger effect on a change in the index than most of the other companies that are in there. So right now the market's up about 11% year to date, the S&P 500. But if you equal weighted all the companies, it would be significantly less than that. If you took the stocks out altogether, it would be significantly less than that. So the question is, okay, when tech stocks cool down, where do people rotate to? Mm-hmm. Well, right now, interest rates, the stocks are going up because they're looking toward future decreases in interest rates. And because they're worth more in a lower interest rate environment on paper, they're looking ahead at least a year. But when rates actually start to drop, then all of a sudden people are going to look for yields. They're going to look for income. And right now bonds are at a pretty high level. People can find income in bonds and bank CDs. But when interest rates start to drop, that's going to change. And when that changes, now they're going to go back and start looking at high dividend common stocks so they can get a decent yield and they can get some growth. So that's when money starts to rotate from growth into high dividend value plays. And that's where, there's a saying on Wall Street, you hear it sometimes on the news, that says, buy the rumor and sell the news. In other words, by the time the news comes out, it's too late. It's already priced in. And this could be one of those things with this tech stock rally, that if they start lowering rates in September or December, we might find that, we've had 2 good years in a row of this tech upswing last year and this year. And next year we might go back to traditional value-based high dividend American companies and tech might be back out of favor again.
Yeah, so basically the pendulum's going to swing in the other direction.
It always does.
And
over the long run, higher dividend value stocks tend to do about the same as growth stocks, but they go in cycles. And again, if you try to time the market, you're going to drive yourself crazy. You're going to be like that person switching lanes that doesn't get ahead of you. Yeah. And that's why I told Jeff that the news we're seeing right now isn't really enough, in my opinion, to make a major change in your portfolio. That it just again, it's 1 quarter, it's 1 month, hang tight, and it's not that significant.
Yeah, but maybe there's some opportunity here. And our next Ask Dave question has to do with that. We have Greg from Georgia. He said, you mentioned the interest rates were high, so should I be trying to lock in those higher interest rates now?
Greg, great question. And the answer is, most likely the answer is yes. If you're retired or close to retirement and you're looking for this money to generate income for you, you should be starting to make that transition. Now, the good news, you might have a little bit of time left. I don't think it's a rush thing that you have to jump into, because right now you have short-term interest rates higher than long-term interest rates in some cases. You have CDs, 1-year CDs that are paying over 5, where the 10-year government bond is under 4.4. So you get paid less for making a long-term commitment. Why? Because right now everyone's predicting that on average over the next 10 years, rates are going to be lower. So what's likely to happen is at the beginning, the Fed starts lowering short-term rates, but long-term rates might end up a little bit sticky. Because again, at some point this interest rate curve has to right side itself. At some point, long-term rates have to reward investors more than short-term rates. But shortly thereafter, long-term rates will start tracking down with those short-term rates. So a lot of people right now are getting locked into, they're doing these 1-year CDs and treasury bills, and they're excited because they don't have to make a big time commitment. They safely get some interest. But remember, over the last, let's call it certainly decade and a half, almost 2 decades, the average interest rates have been much lower than they are today. And the Fed is saying they're going to lower rates. So when they go back down again, eventually short-term and long-term will be down. And we know the Fed's not going to raise rates again at this stage, or they've signaled everything that it's unlikely to do that. So yes, it means that sometime this year is probably a good time, if you haven't done so already, to lock in some higher interest rates with things like bonds and preferreds. And if you want to take a little bit more risk, again, maybe some higher dividend common stocks.
All right, Greg. So there is some opportunity there for you. And thank you so much for sending in your question. If any of our listeners have a question that you want to ask Dave, all you have to do is send us an email to askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking about the different economic reports out there and really what it means for you and how it's going to affect your retirement. So, Dave, you mentioned a little bit earlier that, now what you're seeing out there, you don't think that the Fed's probably going to raise interest rates until maybe the end of the year. So there is time to lock in the rates if you...
Lower interest rates by the end of the year.
Lower interest rates by the end of the year, right? So it's there's some opportunity to lock in right now. However, when is the time that people do need to make a change to their portfolio? Of now isn't a time to make urgent changes to it?
So first of all, I'm a fan of more opportunistic changes, not changes running because you think something's going to plummet.
Changes. You like
if you make a defensive change, the only reason time you should do that is if you've been taking risk too long. If you've been overly aggressive position for your goals and you know it, and then you're nervous, well, then you're probably smart to make a drastic defensive change. But if you're allocated right, you shouldn't have to make major defensive changes. Think about it. If you made a defensive change when the pandemic hit, well, it only would have benefited you if a few weeks later you got back in at the bottom. But most people were afraid to get in. And within a few months, the market surpassed its pre-pandemic level, right? So you would have been locked out of it. So if you're making a change proactively to take advantage of something like high interest rates where the Fed's signaling they're going to lower rates, that's smart. That's not gambling. That's actual investing. So that's one time that people should consider a change. The other time is really when you look at your goals and objectives and you realize you're just not aligned. And again, to me, that's the real reason to make a defensive change, regardless of what the market's saying, regardless of what the talking heads on television are saying, is to make a change because you're not allocated properly. You're in a position maybe that's too risky, that doesn't generate enough income. You're getting close to retirement. Even if you think the market's going to go up, you should consider that because it's not about making the most money on the block. It's not about you getting a better return on investment this year than all your neighbors. Yeah. What it is about is making sure that you can live the life you want and reach your retirement goals.
Yep. And I think a lot of our listeners are they might be thinking, hey, I'm allocated properly for my own risk tolerance. I'm in a good position. But I talk to our advisors, our income specialists every single day. And the number one thing they tell me they hear from clients is they say people don't realize how much risk they're taking. They don't realize how outside of their tolerance level they really are with their current investments before they work with an income specialist.
Great point. Sarah, oftentimes we'll stress test portfolio for a prospective client. We'll look at various bear markets in history. And before we do that, we ask somebody, what's the greatest loss you're willing to take on paper? And they'll give us a number. And then we stress test it. And I would say at least 8 out of 10 times when you stress test the portfolio, bear markets in the past have had a much bigger drop than they say they're willing to take. And that's eye-opening. But let's say you're allocated properly. Let's say you're in a 60-40 portfolio, 60% stocks, 40% bonds, and that's where you should be. Yeah. But your stocks are more growth-oriented. They don't have a high yield. And now really what's supporting all the yield, the income from the portfolio are the bond side, which is 40%. But you're going to be retiring in the short term. Well, guess what? You still need to make a reallocation. You could stay 60-40, but maybe you have to go from growth stocks to more high dividend stocks. Because the key to not taking too much risk is knowing that your portfolio is generating enough income that you're going to want in retirement. As long as it's doing that, then even if the portfolio drops in value, well, it doesn't matter as much because it won't change your lifestyle. It won't force you to work longer because now you have staying power. So again, even when you think you're allocated properly, percentage-wise, you still have to make sure it's generating the income that you're going to want.
Absolutely. Well, I think that it's important for our listeners to understand the proper allocation, of course, ways to generate income, and that it's the same investments that they're invested in now. It's just the income version of it instead of the growth focus version of it. So we're going to talk more about ways that you can maximize your income, especially in retirement, and how there are different ways you can take advantage of what's going on now, some opportunity out there. I'm Sarah Samuels here with David Scranton, and you're listening to The Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking about the recent economic news and what it really means for your portfolio, especially when it comes to your retirement. Dave, we were talking about how the proper allocation can be, 60-40%, but if someone is really invested in growth stocks primarily, that can be an issue as opposed to being invested in high dividend yielding stocks that are generating income. So can you talk a little bit about how some of the same investments that people are invested in now pre-retirement, they're going to be invested in those the same way or in a different way, but they'll be invested in those in retirement as part of the income generating strategy.
That's right. There aren't a lot of new investments out there, and you generally want to avoid newfangled strategies and investments because oftentimes in the early stages, those make Wall Street a bunch of money and leave you with 2 cents. So that's really not the goal. But yeah, as you said, just closing out the last segment, Sarah, it's really true that pretty much anything you could do in a growth way or an income way, right? Stocks, you can get in growth stocks that don't pay much in dividends, if any, or you can get in dividend stocks that pay dividends and can also give you some growth. Bonds, you can get zero coupon bonds like savings bonds, but you can get zero coupons other than savings where you buy them at a price and they don't pay out any interest, but they appreciate in value. Or you can get regular bonds that pay out periodic interest payments. You could even get into commodities, which pay no income. They're just commodities. And if you want to get creative, you could write covered call options on your commodities and turn them into an income tool, an I tool instead of a G tool. Heck, you could even take Bitcoin, which pays no income. And you could stake your Bitcoin, lend it out, and get income from it. So pretty much everything out there can be done in a growth way or an income way. And the key is to use those same instruments that you've been used to your entire life, but now look at them with a different pair of glasses. Instead of looking at them with a filter about future growth rate, you're looking at those things and trying to pick through those things, or your advisor is, with an income first and then growth second mindset.
Yep. And if our listeners out there, if they're not working with an income specialist, they might be working with a financial advisor that really just pushes a lot of these growth opportunities because they don't have the same resources, the same knowledge that income specialists have to properly generate income.
Well, we're trained as advisors, Sarah, to look at total return. That's our training. And their goal is to figure out total return and how to get the most for the client. They're really not taught how to parse out the income component and the growth component. And they do teach it a little bit, but then they go back to total return. And we're usually judged based upon total return. Well, the S&P is up over 11%. How much are you up? So it doesn't matter if I'm up 20%, right? I'm up almost double the S&P. But if the person's number one goal is to generate income to replace their paycheck in retirement, and I'm not getting them any dividends, it doesn't matter.
Right. Yeah. You're not meeting their goals. You're not going to be able to help them meet their goals in retirement.
100% true.
Yeah, absolutely. Okay, let's get into our next Ask Dave question. So this is a great question. This comes from Caroline, located in South Carolina. She says, Caroline from South Carolina.
Figure that out, huh?
She says, how do I know, and this is a common question we receive, how do I know how much income is being generated from my current portfolio?
All right, Caroline from Carolina. I think she might be pulling our leg, Caroline.
Maybe
Caroline.
this is a pseudonym here.
I know. Gosh, you can't make this stuff up, can you? So Caroline, how do you know? Well, it depends where your money's invested. So if you're in a brokerage account, so you're with an advisor and they might have Fidelity or Schwab or maybe Merrill Lynch or Morgan Stanley, you may have a yield column, usually over to the right-hand side of your statement. And the yield gives you a percentage income. And you have to look to the bottom of it to figure out what the total is, and that'll tell you your income component. Now, I have to forewarn you that not all companies have an income column. In fact, some independent advisors actually take the income column off. Like, for example, as independent advisors, we clear through Schwab and Fidelity. That means our clients get statements from Schwab and Fidelity. And with Schwab and Fidelity, we have a choice. Do we have an income column on, or do we take it off? And most of the total return advisors who are not income specialists take it off because it just doesn't reflect well on them. So what if you don't have that income column? Then what can you do? Well, then you have to perhaps look to the top, and there's a section which talks about interest and dividends paid. The problem is you pretty much want to look at a June 30th or a December 31st statement. And if it's June 30th, you can multiply it by 2. If it's other statements that may not be accurate, because some investments pay interest semi-annually, so if it's quarterly or if it's February or May's statement, you can't really extrapolate and figure out how much interest it is in a year. So that doesn't work. The other time that's really difficult, Caroline, is that if you have a 401k. Remember, 401ks are accumulation vehicles. They're not income vehicles. They're there to attract and retain young talent. So they're purposely growth vehicles. And as a result, I've never once seen a 401k that talks about how much interest and dividend is generated. So then you have to go to other sources, like you have to look up maybe Morningstar and look up the yields on some independent reports for each mutual fund separately. But the easy way is really to talk to an income specialist. Usually an income specialist has software. They can put all your holdings in, and they could tell you almost to the dime what percentage income is being generated from your assets.
Absolutely. Well, Caroline, thank you so much for sending in your Ask Dave email. And if any of our listeners out there, even our YouTube viewers, want to send in a question and maybe hear Dave answer it on a future show, all you have to do is email us at askdave@retirementincomesource.com. And thank you for spending some time here with us today on the Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about how the different economic reports out there might be affecting your retirement, ways it can lead to some opportunity for you based off where you are in your retirement journey, plus some different myths out there, some different ideas. People have this mythical idea that, hey, income, it's some weird thing, when really, Dave, it's not. It's just a different way of investing as opposed to investing with a growth focused investment. Same investments, though.
We always talk about it. You could buy real estate as a fixer-upper and try to flip properties, or you could buy speculative land where you get no income. It's all about the G. It's all about growth, right? But, and of course, sometimes it backfires. You invest for growth and things drop in value. You get an L, you get lost instead of a G, right?
Yep, it happens sometimes. You can lose a lot.
Or you can buy real estate and have rental property, in which case you're getting both. You're getting the income and you're getting some growth potential. But when I talk to most people about rental property, and they say, why do you like your rental property? It's because it's income based. I like having a little growth potential, but I like that income. Income first, growth second.
Well, I think it's very nice to actually have the investment. First, it's generating money from you. It's generating income the right way. And then if you want to sell it off, in the case of the rental property, you can hopefully make some money there too. So it's almost a win-win situation.
It's a win-win. So it's not income with no growth. It's income first, growth second, which is why if you're getting the income first, you shouldn't be reacting to hardly any financial news. Yeah. Except the one exception that I like to paint is, like I'm kind of saying right now, the Federal Reserve, right?
Yeah.
The Federal Reserve can control a lot of values in stocks and bonds by manipulating interest rates, right?
Yeah.
Like we said, interest rates go down, things go up, interest rates go up, things go down. That's telegraphing. So when the Federal Reserve is saying what they're going to do with interest rates, and you feel like you could trust them, that's a time that you might be able to make more opportunistic changes.
Yeah.
For example, you go back a few years when they were saying they're going to raise rates. Well, at that point, a great place to be. Bonds aren't as safe when they're raising rates, right? You can have a drop there because interest rates go up, bonds go down. And the low dividend growth stocks hate it when you raise rates. So they're painful. So where do you go? You go into higher dividend stocks. And the higher dividend stocks did very well, outperformed the market by a landslide as a general rule when they were raising rates. But then now the Fed is telegraphing dropping rates, right? So what does that tell you? That tells you that it's a great chance to, lock in some rates with bonds and things like that, as one of our listeners just came in with and said, hey, how do you take advantage of this this fact that the Fed is telegraphing it? So that's one of the rare times when I think maybe making trades on economic news can actually make sense.
Yep. Do you think there's any other times when it does make sense to make changes based off what you're hearing, or not really? Just if you hear the Fed say it, then we can mostly trust something's going to happen down the road. But otherwise, you got to stick to your guns and not listen to everything you hear.
Well, you think back, hindsight's 20/20, right? But when you think back to 1999 and you look at all the technology stocks, that price to earnings ratios of infinity because they were making the denominator, the E and the PE ratio was zero. So you divide anything by zero and it's infinity.
Undefined.
That was clearly a time when, okay, we have to get rid of some of these tech stocks. They're not going to go to the moon, right? So there are times like that when it becomes somewhat more obvious. And the financial crisis, if you really had your ear to the ground, there's some changes that you could have seen to make maybe in 2007. But again, you really have to be in the game to recognize that.
Yep. Well, regardless of what's going on in the news, if you are heading into retirement, if you're just a few years away from it, it's absolutely going to be time to make that change in your portfolio, and we'll discuss that more. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels, and today we're talking about some of the recent news with the economy, with inflation, what the Federal Reserve intends to do, and we're deciphering which piece of news that you should act upon within your portfolio versus which pieces of news are really irrelevant for the long run, where you should just stand pat. And so far we discussed the fact that if you're allocated properly, then defensive reallocation to protect your money should be unnecessary, because you should be approaching retirement with enough interest and dividends being generated from your portfolio that you're not worried about a loss, because you lose money, you have staying power. However, making changes if you're not properly allocated for your goals, so basically you've been taking a little too much risk too long, then that is a smart move. That's a good time to make that change, to get in line with your retirement goals. And also, if you're doing proactive changes, if you're trying to take advantage of interest rate cycles, which most commonly, as we said, Sarah, are telegraphed by the Federal Reserve.
Right. Yeah. You mentioned if the Federal Reserve starts talking about it, most of the time they're going to follow through.
And you know how the Federal Reserve and interest rates can manipulate parts of the market.
Right.
But I said before, if you sold at the beginning of the pandemic, so first of all, you had to be right that the pandemic was going to, close down the United States and hurt the economy. So you had to be confident that that's what, the presidency and Congress is going to do. And you had to get ahead of it. And then you had to have the courage to jump back in a few weeks later when the government started introducing all these bailout programs. Yep. And the problem is, sometimes you get out and you don't know when to get back in. Is it really the bottom? Is it not? You stay out, and within a few weeks, we were back up at pre-pandemic levels. So in most cases, that type of market timing wouldn't have worked.
Yeah, it wouldn't have made any sense. Yeah.
Now think back even further. Think about World War II. Okay, let's say you got news, and let's say news were as active as it is today, and there's a report that there's some bombers coming over from Japan to Hawaii, and you say, "Oop, they're going to bomb. We're going to get pulled in the war. I'm going to get out." Now, back then, the news was snail mail. It wasn't quite like
slower,
that. That's right. But let's say now you had that, and you say, you get online, and you push a button, and you sold everything. Well, yeah, the stock market reacted negatively after that happened, and we declared war.
Yeah.
But very shortly thereafter, we turned our economy into a wartime economy. And all of a sudden, women were going to work in droves for the first time really ever in our country. And we're being very, very productive because of this wartime economy. And the stock market started coming right back. So again, market timing is scary with that type of thing. Yeah. As long as you're getting enough income to generate enough income to hit your goals, then you have that staying power. You shouldn't have to make changes. Again, unless they're opportunistic.
Yep. Well, market timing is something, it's one of those things that can be very difficult to do. And our next Ask Dave question actually has to do with that. We have Jim from Ohio. He says, I want to do some market timing with some of my money and more aggressive investments. But the only thing is I'm recently retired. So what's your best advice?
Hey, Jim, great question. And people want to be in the game. Today's 60-something-year-olds.
FOMO, right, Dave? You mentioned that. The fear of missing out.
We talked about that last week. But it's because today's 60-somethings are like, yesteryear's 40-somethings. So as a result, it's not that old person sitting on the sofa in retirement. Yeah. It's the person who wants to do more things. And part of it is feeling young, feeling like you're still in the game. But, Jim, here's the key. First of all, make sure you're generating enough money, enough interest and dividends to satisfy all the goals you want in retirement. Now, if you can do that with high dividend stocks, then you can, because remember, high dividend stocks pay a little bit less income than bonds and bond-like instruments as a general rule. But if you could pull it off with high dividend stocks, then great. You still have some upside potential. You're in the game. Okay? But let's say you want more than that. Well, then what I would recommend is maybe doing a barbell strategy, maybe doing more bonds and bond-like instruments instead of high dividend stocks, so you can get a higher percentage income off that part, and you have a little more safety. And therefore, you don't need all of your money anymore to generate income, in which case you take the part that you don't need and you get a little bit more speculative. Because then, if they drop in value and stay underwater for 13 years, Jim, like happened at the beginning of the century, the market was underwater from 2000 to 2012, at least you have the other part of the barbell strategy, the bonds and bond-like instruments, conservatively generating income. So, and by the way, if you are going to be speculative with that part of your money, then please, please, please diversify. don't put all your eggs in one basket or even a handful of baskets is probably the most important advice.
Yep. All right. Well, Jim, thank you so much for sending in your question for our Ask Dave segment. And if any of our listeners have a question that you want to ask Dave, maybe about retirement or maybe something you heard recently in the news, all you have to do is send us an email to askdave@retirementincomesource.com. And thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today's show has been all about the recent news reports and why you shouldn't necessarily let it affect the way you're choosing to invest. And Dave, you brought up this great point, which is if you're allocated properly for income, you're nearing retirement. If you're allocated properly, you really shouldn't have to make a lot of defensive maneuvers, and you really don't need to listen to all the talking heads out there. Now, it's different when we hear from the Federal Reserve if they're going to raise or lower interest rates. But really, your changes, you want to be proactive, look for opportunities potentially, but you want to make sure your allocation is the correct
whatever
way.
percentage you're going to have in the stock market, if it's 10 or 20 or 40% in retirement, could be 60%. Well, when you hear rates are going up, that's going to affect the growth stocks. So you get a little more dividend-ish, right? You hear rates are going down, maybe it's a chance to lock in some rates, right? Whether it's in high dividend stocks or bonds and bond-like instruments. So the point is, you know that, and that's pretty predictable.
Yeah.
And again, the reason, I can't stress this enough, I sound like a broken record, but for good reason, you have to, if you're getting your income from interest and dividends, it won't affect your lifestyle if something drops in value.
Right.
So from a left brain logical standpoint, it doesn't really matter. You can still do everything you want in retirement, right? Just like if you're working and all of a sudden your company is worth less because your company stock drops.
Right.
Well, your net worth may have dropped. Maybe the stocks in your 401k drop, but as long as your paycheck's still coming in, you're fine.
Hopefully it's not tied to your paycheck, right? You're not making less if the company earns less.
That's right. So if the stock market drops and you're working on Wall Street, maybe it's going to hurt you, right? But otherwise it won't. Now, there still is that emotional component of it. You early on the show at some point you said about people being in aggressive positions. And I talked about stress testing. Because the reason the stress test portfolio is relative to people's risk tolerance level is because there's an emotional component. There's a right brain component, right? Just because you know that the income hasn't changed, just because you know that it's coming in, and I don't have to cut my spending, it still doesn't mean that you're going to be able to enjoy spending all your income knowing that your net worth just went down. So that's where you've got to do some real soul searching and look in the mirror and say, okay, how will this affect my spending patterns? Will I react? Will I be able to enjoy retirement less because of this? Because like that famous Worth Avenue story I always talk about in Palm Beach, when Bernie Madoff was, when they finally found out that he was a crook and he made up all these account statements and everything, there was no one shopping on Worth Avenue in Palm Beach. And for you who are unaware, Worth Avenue in Palm Beach is like the Rodeo Drive of Palm Beach. And it was right after Bernie Madoff was discovered to be a fraud. And I was walking down Worth Avenue with a friend, and we just all of a sudden looked and said, whoa, there's nobody out in the streets. And these are extremely affluent people who were shopping on Worth Avenue, and they didn't give all their money to Bernie Madoff. Smart, wealthy individuals don't give all their money to one hedge fund, maybe one advisor, but not one hedge fund. So they still had a lot of money left, but they just didn't feel comfortable shopping on Worth Avenue. Even though they had the money to do it, they didn't feel comfortable because they just lost a good chunk of their net worth. So you got to think of the psychological components too and how it affects you.
Yeah, absolutely. Well, I think that the psychology of it is a huge thing, and I think that's part of why people become influenced by stuff they see on the news or commercials out there, different influencers, because they have the FOMO, which we talk about, the fear of missing out. They hear somebody's doing something, and usually by then it's already too late for you, but you want to jump in, right? Because you don't want to miss out. And people are also really scared of change in general, and I think that it's hard for them to make that change of that growth focus to really making that income first, growth second change, and that focus in retirement or as you enter retirement.
And sometimes it's funny because the defense mechanism of people will say, well, I lived through 2008, the financial crisis. It didn't really bother me. And I say, well, were you retired then?
Right, and that's a different story if you were working or retired. Exactly.
Yeah, in fact, if the market drops and you're contributing to your 401k, that's a good thing because you're dollar cost averaging, you're buying more shares. But when you're retired and it drops, it's a bad thing. It's totally negative.
Yeah.
So I encourage people when they're confronted with making that change, to go to more income first, growth second focus, which hopefully you have an advisor in your area that's confronting you with this, that you look at it and say, well, what's the pain of each change? Yeah, change is scary, but in many cases, my clients tell me that what's even scarier is having a 20 or 30 or even worse, 50% drop in retirement or approaching retirement, especially if they're not already generating enough interest and dividends to give them the income they want.
Yep. Make sure you're working with an income specialist. So thank you so much for listening to today's episode. If you want to listen to the show again, or maybe send it to your family and friends, all you have to do is go to retirementincomesourceradio.com and listen to all of our past episodes there.
And most important, make sure that you're here to join us next week. Same time, same station. I'm David Scranton here with Sarah Samuels, and you've been listening to the Retirement Income Source, where it's all about the income.